What will you listen for in the press conference tomorrow?
Really just the kind of tone that Powell sets in the message. There's obviously good growth in the economy. Both Q2 is really strong. Q3 is coming in really strong. And just really their conviction on where we're heading from here. And the concerns about inflation. And I think that combined with, if there's any mention on financial imbalances, which has been a hot topic amongst a lot of the Fed speakers, if they're worried about financial imbalances, that could be a cause for concern.
I'm thrilled to have you here after Tony Crescenzi yesterday of PIMCO. We've got George Goncalves of Nomura with a different world than the short-term rate world of Crescenzi. Let's bring up the 30-year bond. This is the old benchmark, not the 10-year. And George, up we go off the president's election to a higher rate regime. And there's every indication here that we're breaking out above 320. Are we, and what does it signal?
Well, I would not get so overly concerned that it's the end of the 30-plus year bond bull market. We can just go sideways for many, many years. I think that's what's been happening slowly. We had the breakout in rates. We're consolidating. Now we're having another breakout in rates. We don't have to have a complete reversal of the last 30 years of a bond rally just because we went through one and have a bond bear market. But we do think that rates are heading higher, and this is really still the beginning of it.
George, what would derail the Fed? So is there anything in the data point, lower inflation, wage growth, or something that could actually make the Fed postpone their hiking?
No, I mean, look, the Fed's on track for at least 2 more hikes, at least for this year, and market generally agrees with that. And even next year, we're basically now at 2 more hikes. For the Fed to really get derailed, there'd have to be some external shock that's not really, being accounted for. I mean, we've had many episodes throughout the summer from Turkey, from other headline risks. And the Fed hasn't really flinched. And so as long as we don't see any sort of contagion back to the U.S., the Fed's going to keep hiking rates.
Okay, but could we see contagion back to the U.S.? So this is a dollar move. What does dollar do from here? The more the dollar rises, then a lot of the countries who have debt denominated in dollar actually suffer quite a lot.
Well, I think that's why it's great to see other central banks starting to join the Fed on their path to normalization. I mean, if we get Europe to kind of get rates higher, and we get the rest of the world raising rates, the dollar will not get unhinged. And I think that's going to be really important for other EM asset classes. But by and large, I mean, the dollar has done a large move. Part of it was a hedge to the emerging market crisis. And if the Fed raises rates at the path that it's projecting, the dollar will stay strong, but not really strengthen that much further.
If we are range bound, is the basic idea here you clip the coupon and forget about total return, or can you actually manage for total return given the Nomura view?
You could. I mean, I think if you are really being on a more defensive side and take a strategic view that rates are heading
I don't want to be in
higher.
the stock market. I want to be in the world of George Goncalves. What do you do?
Well, I think you need to be down the curve and really you have, for the first time in over a decade, cash is an asset class, and money market funds have pricing power. And you're seeing it in the way that the prime funds have been growing. So there is kind of a barbell strategy of having
George,
both short-term paper and very long-term paper makes sense.
I mean, cash as an asset class gives me the shivers. I mean, there's something wrong, isn't there?
Why?
Because
it's normalization.
Cash.
It's un-American.
Is it un-American? It's unworldly.
But it's balanced, though, right?
Okay, but does it tell you that something ugly is around the corner?
Not necessarily.
Just like a reversal in the yield curve.
Not necessarily.
I feel so old right now. Can I tell you how old I feel? I remember when what was cash like 30 years ago? 4%?
More.
3%? More?
Yes.
What was cash at the peak there when CDs were 9% and annuities were 14%?
I mean,
what was
you
cash?
got close to double digits, right?
Can you believe that?
Okay. In what currency do you keep the cash?
Yeah, so look, I think the message here is that the Fed is on track to normalize the way the banking system used to work. And by doing so, overall levels of rates head higher. And that gives you an alternative. Doesn't mean you're 100% cash, but it does create that sort of flexibility to have a barbell strategy.
It's a buffer, right?
Yeah, it's a buffer. You can move some money down the curve. And you have the chart of the 30-year. I mean, 30-year rates that keep heading higher could be also an opportunity as well.
Okay, cash. Cash time.
Cash.
What's your favorite currency? Is there a favorite currency?
Look, I mean, I think the dollar still remains a good store of value. I think it will maintain that case. I mean, like the euro probably starts to kind of pick up here with the transition again as the Fed passes the baton to the ECB. That's going to be the real key focus for us.